Hello everyone. My name is Natasha and I am a chartered accountant by profession and have expertise in direct and corporate tax. Today I'm going to take you through the introduction of income tax in India. Taxes were introduced in India for the first time in the year 1860 by Sir James Wilson to meet the losses sustained by the government. Thanks to the movie Lagan, हमें पता है कि इंडिया में टैक्सेस ब्रिटिश राज ने लाया था. In 1922, a new Income Tax Act was passed and it remained in force until 31st of March 1962. Income Tax Act 1961 was then passed and brought into force with effect from 1st April 1962. Since then, the Income Tax Act 1961 is in force and amendments are brought about every year through the Union Budget. So every year, now on the 1st of Feb, the Finance Minister of India introduces the Finance Bill in the Parliament, which is then passed by both the houses, that is Lok Sabha and Rajya Sabha. And then, after receiving the President's assent, it becomes an act, the Annual Finance Act. All the amendments made in the Annual Finance Act are a part of the Income Tax Act 1961. So, what is tax? Tax is the fee charged by the government. And government ये fees क्यों charge करती है? So that it can provide us with the required amenities and public services. Like say, गवर्नमेंट ने इन्हीं फंड्स का इस्तेमाल करके फ्री वैक्सीन्स प्रोवाइड की हैं. Also, these funds are used to sponsor subsidies and also bridge the inequalities of income. So basically, tax is a form of revenue to the government, and in return, it provides us with the required public services that we would need in our day-to-day lives. Who is authorized to collect tax? The Constitution of India has authorized the government to collect taxes, so we pay tax to the government of India. Now, there are broadly two types of taxes in India. One we pay on the income we earn, and the other we pay on the expenses we incur. So, एक टैक्स हम तब भरते हैं जब हमारी कोई इनकम होती है और एक टैक्स हम भरते हैं जब हम कोई खर्चा करते हैं. नाउ, सैलरी जो मुझे मिलती है और अगर मैं किसी बिजनेस में हूं एंड उसमें से प्रॉफिट्स होते हैं, या अगर मेरा कोई प्रोफेशन है और उसमें मुझे जो फीस मिलती है, these all are incomes, and I am liable to pay tax on my income directly to the government. Thus, this is known as direct tax and is governed by the Income Tax Act 1961. On the other hand, I also pay taxes on my expenditure. So, when I incur any expense, the vendor collects the tax from me on the incidence of expenditure. So, जब मैं कोई खर्चा करती हूँ, जो विक्रेता होते हैं, जो बेचने वाला होता है, वो मुझसे टैक्स जमा करवा लेता है एंड यह टैक्स वो गवर्नमेंट के अकाउंट में डिपॉजिट करेंगे. वो गवर्नमेंट के पास इस टैक्स को भर देंगे. सो गवर्नमेंट चाहती है कि हम जब खर्चा करते हैं तभी भी हम टैक्स भरें, और इस टैक्स को कलेक्ट करने की जिम्मेदारी दी गई है विक्रेता को. सो द वेंडर कलेक्ट्स द टैक्स फ्रॉम मी एंड डिपॉजिट्स इट टू द गवर्नमेंट ऑन माय बिहाफ. So this is known as indirect tax and is governed by the Goods and Service Tax Act 2017. Earlier, there was Service Tax Act, VAT Act, Customs Act, but now all of this has become just one act and known as the Goods and Service Tax Act 2017. So, direct tax is levied directly on the income of the person and is paid by the person directly to the government, whereas indirect taxes is levied on the price of goods and services, and the vendor collects the tax from the consumers and pays it to the government. Now, going further, we are going to discuss the Income Tax Act 1961. The Income Tax Act 1961 extends to the whole of India. It came into force on the 1st of April 1962, and it contains section 1 to 298 and schedule 1 to 14. Now, let us see what are the components of the income tax law and discuss them briefly. The Income Tax Act. The income tax law is governed in India by the Income Tax Act. It has 298 sections, and each section may have subsections. As discussed earlier, amendments are brought about every year in the Act by introducing the same in the Union Budget. The Annual Finance Act. It is the yearly tax law that is passed to bring about changes in the Income Tax Act. Income tax rules is important to be read with the relevant sections of the Act because it contains the conditions, the limits, the guidelines, the basis of valuation of the relevant sections. Say, for example, Section 139 of the Act tells about filing the return of income before the due dates. And Rule 12 specifies the relevant ITR forms to file such returns of income. Circulars and notifications are issued by the CBDT, the Central Board of Direct Taxes, from time to time to deal with specific issues and also to deal with any ambiguities or doubt regarding certain sections of the Act. Legal decisions of the courts. The Supreme Court of India is the apex court, and its decisions apply to the whole country. The High Court decisions passed by the respective states apply to the respective states. Now, this was just a very brief of the Income Tax Act. Let's now see how is it different or similar to the tax around the world. For comparison purposes, I have taken US, UK and China to compare the Indian tax law. Now, in India, tax is levied by the central government, state government and local authorities. Central government levies taxes on the income. State government levies taxes like profession tax, and local authorities levy taxes like property tax, water tax, etc. In US, taxes are levied at federal and state level. In the UK, taxes are levied by the central government and the local government. And in China, taxes are levied at national and local level. The nature of tax in all these countries is progressive, meaning as the income of the person increases, the tax rate also increases. Meaning all these countries have slab rates. So, as the income moves higher the slab, the tax rate also increases. Now, let us see the tax to GDP ratio of these countries. What is tax to GDP ratio? Tax to GDP ratio is a ratio that determines the country's tax revenue based on the size of the economy as measured by the gross domestic product, that is GDP. So, the tax to GDP ratio for the year 2018 is 17% for India, 24% for US, 33% for UK and 21% for China. So we can see that India has performed quite well and the ratio is not very low, or rather it is quite in pace with these countries. So this was a very, very brief introduction to the Income Tax Act. We shall learn more about the Indian income tax in our following videos.
For more such videos, subscribe to our channel and hit the bell icon to never miss an update from us. Also, check out our business mastery courses available on our website www.letstude.com.